Hey, what's up, beautiful people? This is Pope with Stop Dr. Trading. We are here for our third installment of our 7-part series on the 6 most commonly used strategies in a bear market, and this is going to be a fun day. Today we're doing the Burry. This is puts and shorts. This is when you're betting that the market is going down, going down, going down, going down, going down. And so we're going to get into it real quick. But before we do, let's cover the top 6, what they are and what we're covering. We're on number 3 right now. Day 1, we covered the cash-heavy lurker. Day 2, we covered the fixed income lebuma strategy. Today, we're going over puts and shorts, what we call AKA the Burry. Tomorrow, we're going over short-term hedging, the dirty hedgy. Part 5, we're going to cover dollar cost averaging, where you're going to buy that dip, baby. And number 6, we're going to cover China stocks and emerging markets, a trader portfolio. So let's get to it, people. I don't want to waste any more of your time. All right, really quick. We're not going to get into too many of the basic technical details on short selling and puts. If you don't know what they are, there's lots of resources online to look up what they are. And this is a very highly technical type of trading. So if you're a beginner, this is not for you.
Look at yourselves. You know, you pass yourself off as cynical people, but you still have some faith in the system, don't you?
I don't.
Well, except for Vinny. And who gives a shit?
No.
Okay, I do most of my short selling and put buying on Fidelity Active Trader Pro desktop. Okay, but just a real quick breakdown of what short selling is. It's actually like a 2-step process in order to get to market and get out of market with it. So basically, instead of when you just buy a stock, hold it, and then sell it, what you do here is you borrow the stock from the broker. Let's say it's 10 shares of Apple. Then you go and you short sell that on the market. All right, if that stock value goes down, you go ahead, you pull that out of the market, you cover your short sell, you return your shares that you borrowed from the broker, and the transaction is complete. That is a full life cycle of a short sell. A put is much different. A put is part of the derivative market of options trading. That means there's a lot more risk because with options, you're not just dealing with price action, you're also including time action and volume action, the amount of people in the trade. So you really need to take your time and gain your experience if you want to get into shorting the market, because with shorts, you're going to have to take on margin. Margin is very, very risky. There's nothing about this particular strategy that is not risky, but it also provides heavy rewards for those who pull off their trades accurately and timely and succinctly. But you have to understand that you're measuring more than just price action now. You're in a 3-dimensional focus in order to make a positive trade. And this takes a lot of understanding, and it also takes an understanding of macroeconomics, events that could be happening, Federal Reserve meetings, reports coming out, things that could have just kind of overall up or down push in the market. You need to be aware of all those things. So this strategy is not for the rookies.
I work at a college as a janitor, even though I feel like I'm smarter than most of the people that go there. Sometimes I see an equation written on a blackboard, like half an equation. I'll just figure it out.
Is this Good Will Hunting?
No.
Sounds a lot like the plot of Good Will Hunting.
Yeah. Anyway, my best friend is Ben Affleck.
This is definitely expert level, okay? So let's get into it now. If you're thinking about taking on a put and short strategy, basically what you're going to be thinking in your mind is this market is headed downhill for the foreseeable future, could be a while, and I still want to profit off that. You also might be believing we are in an everything bubble and asset prices have been way overvalued for way too long in this market. And that's somebody who might be looking back to the charts and seeing what valuations were in 2019, just before 2020. And when quantitative easing started their full-on unlimited quantitative easing, where stimulus of the markets and financials and the bond market especially was created in unlimited, unprecedented fashion. If you're of the belief that now that quantitative tightening is here and they're pulling everything back, there's no more stimmies for the banks, and this is going to drag down equity values for the long term. This is what you're thinking, this is your mentality, and this is why you would lean towards this strategy if you have these particular beliefs. This is called the Burry for one very specific reason. There isn't a more famous short seller in the world than Michael Burry that I can think of, especially amongst the mainstream, because he was a famous part of the movie The Big Short after the 2008 crash. Now, Michael Burry and I, we are like Zen brothers, other mother brothers in every single way. I left finance in 2006, working for a hedge fund company as an inside trader, working on swaps and options, collateral management, and fund accounting. And I was able to see that we were trading CDOs and other IOU pieces of paper type of assets that were really going to take down the mortgage market, mortgage-backed securities, and inevitably it did. That was the very instrument that did so.
In case of solvency issues with your bank.
I'm sorry, are you for real? You want to bet against the housing market and you're worried we won't pay you.
Yes, that's correct.
He was screaming to high heaven in whatever channels that he could about what was happening back then. It happened. He played it right. He had a struggle getting there. It's very difficult to be a bear. You understand? So take a look at what he's warning on Twitter all the time. Here he says, prepare for inflation. Reopening of stimulus on the way. Pre-COVID took $3 of debt to create $1 of GDP, and it's worse now. In an inflationary crisis, governments will move to squash competitors in the currency arena. Dollar still being very strong. He put this out in February 2021. I think we're seeing exactly that play out. All right, next on this tweet here, he also said right after that, more can be found here. History is not useless and wisdom is not extinct, though the aimless and wanton youth having a day again for now. This text explores the 1970s American inflation, which is more relevant today than one might think. What you have to think about in February of 2021, what was happening? That was the GameStop AMC revolution of information that we just experienced, where the apes came out of the woodwork and we found out how much the market was being manipulated. So he let us have our fun with that. But don't forget, he was on the GameStop, bullish on GameStop back in the day too. He made a good little clip on that. So he's not always Mr. Short, just when the time is right. So he had good old Kathy Woods come in and chime in a little bit here. And she happens to mention in August of last year, she said, to his credit, Michael Burry made a great call based on fundamentals and his ability to recognize the calamity brewing in the housing market and mortgage market. I do not believe that he understands the fundamentals that are creating explosive growth and investment opportunities in the innovation space.
You're crazy, man. You're crazy. I like you, but you're crazy. I feel tired.
Let's see how ARK is doing ever since August 17 of 2021. All right, and so he who casts stones in glass houses can crumble down very quickly. Correct, Senora Woods? And I'm pretty sure Michael Burry's response to that was just a direct, you're blocked. One of the things that I basically like to express to people, if you're interested in this strategy, is just understand that being a bull in a bull market is smart and easy. But being a bear in a bear market is wise and difficult. It works a much different way than just the simple buy the dip, this is the reverse put the peak. I mean, that's what we talk about. But the time frame of this is very much different. And the algorithmic force of a down market is much different than on its way up. What we really want to think about here, let's simplify everything. Let's get this really straightforward. I was bullish on the market during quantitative easing, and I became bearish on the market during quantitative tightening. As soon as they were about to pull back quantitative tightening and they started talking about it, I knew the discussion was there to set expectations for the tightening. So they began tightening in June 15th. They stopped easing March 15th, and you can see what's happened to the market ever since. Since then, globally, we've had roughly $1 trillion being pulled out of all the Federal Reserve's balance sheet over this past 3 to 6 months. And this is the market impact that we're having. As simple as it goes, as long as I'm continuing to see quantitative tightening, I'm shorting the market in the long term. And when I see that reverse and they start stimulating the market again with the quantitative easing or a reduction in rate hikes, then I will be bullish again. And it's just that simple. And you can just follow the charts Just that clear. Just be prepared because it's not as easy as buying the dip. All right, beautiful people. All right, so we've covered a lot of stuff already, but let's just go over really quickly the pros and the cons of being in a short put strategy. If you want to play the Burry, this is what's good about it. All right, first off, it's easy to understand. It's the opposite of buy the dip. Instead, you put the peaks and sell the rips. Now, when I say it's easy to understand, that's the strategy of itself. The technique for pulling off this has a lot more technicalities involved because you either be dealing with margin or you'll be trading on derivatives and options. And both of these require specific knowledge as well. But it's easy to get the concept. Same thing in reverse as the past 10 years of buy the dip has been. Now you're putting the peaks until we see that, quantitative tightening stop. That's what we'll be doing. All right, so it's a risk-on strategy for those who are not risk averse, who are looking to grow their portfolios, because it is true. You can make a lot of money in a bear market. One of the good things about trading on options, even though they're highly risky, is that they settle in one day. Your cash settles in one day, as opposed to a short trade or any kind of stock that you buy straight out, which is going to be T+2, trade date +2, which means that it takes your time and money to settle over that period of time. Options are far more liquid in that sense, and they give you the ability to kind of day trade at a faster pace than most people who are under $25,000 pattern day trader account can do. So that is a pro. Of course, we've got some cons in this scenario too. Always gonna have some cons.
Welcome to Con Air.
Number one's your margin call, right? You could put into a margin trading at your brokerage account, which is not recommended. It's not recommended to do this because you're risky. There are techniques where you can do this when what you're gonna do is, if you are in margin, let's say you've got 10,000 bucks, 5,000 of that you're gonna hold in cash, 5,000 you're gonna trade with. That way you always have your own buffer of cash, that even though you're trading on margin, you're gonna have your own cash backup. So you're actually not on their margin with half your account, but you can still get burnt with this if you don't set your stop losses. So there's a lot more technical details we're going to have to get into to cover this strategy as specifically as what it takes to pull off the trades. But for now, we're just covering what are the 6 and which one are you. All right. So another one is that bear markets tend to happen faster than bull markets. There's much more volatility because there's less money in the system. So that less liquidity means much more jumps in prices. It means you can see a lot of bull market rallies that can really throw off, especially if you're trading with puts, and timing is everything. So it's important to note how difficult that can be if you're not really understanding the full swath of the news on the market at any given day. The market tends to want to go up. I was alluding to this earlier. So even as it's going down, so these rips can wipe out short sellers, not thinking of algorithms that are built to put in liquidity sweeps, searching for certain volume profiles that have a lot of sellers waiting for them there. And they'll run the price up on those people just to wipe them out and then have it come on back down. So you have to be prepared for understanding the type of market climate that you're in. It's under heavy influence from algorithmic trading. Most likely 80 to 92% of all the trades in the stock market on any given day are happening from machines or algorithms that are trading at high frequency levels.
If I were the man I was 5 years ago, I'd take a flamethrower to this place!
So we need to know that that is the big influence in the market at any given time, and you have to ride the waves rather than going against the current. All right, beautiful people. So this is a big part. I'm actually going to reveal a little bit of my own portfolio, my own strategy right here. I'm calling this the Burry. You might be able to call it the stock doctor too after the past 6 months. Basically what I've been doing for the past 6 months is shorting the banks.
God damn it, Gump! You're a goddamn genius. That's the most outstanding answer I've ever heard. You must have a goddamn IQ of 160. You are goddamn gifted, Private Gump.
All right. You can see right here, this is a watch list I put together in November of 2021 of just anything in the finance sector I thought was going to be vulnerable to quantitative tightening and the reduction or the increase of interest rates, just the reduction of liquidity as a whole throughout the entire market. So you can take a look here. It's got all the big boy investment banks on it. You know, your Morgan Stanley's, Wells Fargo's, JP Morgan, Bank of America. There's BlackRock, Citigroup, Wells Fargo, PNC, State Street Bank, Deutsche Bank, Credit Suisse, Goldman Sachs, and we even have a couple commercial banks in there just to compare how they're doing as in the interest rate environment as opposed to investment banks, because they tend to do a little better with the rising interest rates than an investment bank, which is much more heavily invested in its assets, right? So knowing this and knowing that investment banks were going to be dealing with lower equity prices, lower asset valuations, it was very clear to me they were going to come down. Everybody said I was crazy. Everybody said I was crazy. Everybody said that there's no way the Fed is ever going to start raising rates. There's no way they're going to stop QE. There's no way they're going to do all this. I'm in November and I am like, talking with my communities and we're like rapping about all this. And I'm like, guys, I'm getting ready to short the banks. And it's going to be that time. And people do not understand. Like the day before the December 10th CPI print, I said, if that is 0.1% over the expectation, we're heading down. And it's exactly what happened. Now, of course, we had, this first kind of buy the dipper reaction after that started to happen. But what happened, I started doing this around January 3rd. You can take a look here. I started buying puts in Bank of America, JP Morgan, Morgan Stanley, Citigroup, Goldman Sachs, BlackRock, Deutsche Bank, Wells Fargo. I started writing them down. Now, we had several bear market rallies during that time. I was able to get out at lows and ride it up and then pull back down as well. There was one particular rally that happened right after the initial plunge in January off the CPI news. There was a rally right on back to almost basically what was an all-time high. And I got wiped out on that particular section of time. I think it was probably 10% of my portfolio at the time that was leveraged in that. And it came right back up. But what was so amazing, I re-upped on it. I believed in my call. I buried this one. And almost just within the week after re-upping on my shorts, the banks pulled down so drastically. And they've just been on a down run ever since. It was about 2 or 3 weeks ago on a Friday that I decided to pull back from this strategy for now. Basically because I don't see any more of the catalysts in the next little while that are going to trigger the major trend. There's still some money flowing around. There's still fractional reserve lending that's lending some sort of stimulus into the asset prices and asset valuations. And what we're starting to see is that moment right now where consumer expenditure and pricing is starting to really weigh down the economy, where in July we'll be officially in a recession. And thank you. Someone else noticed it too. And basically, like, I will re-begin this in the July process. I probably will have a short on the bank portfolios. I'm also seeing that tech and growth is recovering really well right now during this lull. This is what I would call sideways trading. Remember, all we're ever really doing is arguing whether this baby's going to go up, down, or sideways. That's all the complication really is about. I'm pretty sure I will reinvite my regular old shorting and putting strategy back in July, waiting out this kind of June lull. I mean, it's July right now, but later in July, after the Fed meeting, after a couple more pieces of data come out, after the CPI data comes out for June. And that's when I'll pick that back up. All right, beautiful people, thank you for paying attention to my little short in the bank, watching them tank, little play. I definitely faced a lot of scrutiny during this play, not just from people around, but from myself, as I definitely had to fight through certain bear market rallies during this whole time. But it worked out. If you were my friend or my friend on Discord or part of any of my communities, you know I was singing from the mountaintops to short the banks. So it was your choice whether or not you wanted to hear me, but I took advantage of it. That being said, I want to use that as an example of how you can identify what you might be interested in shorting as we go forward, right? So we're already about let's call it 5 months into the bear market happening right now. And like I said, we're at kind of like a little bit of a lull. What I was doing when I decided to short those banks and putting together my watch list in November is I was thinking ahead of the curve. So I'm thinking, okay, what has done the best in the bull market? Is that will most likely have the most negative repercussion in the bear market? And that was really financials. You can see here, GDP as of Q1 2022, financials are the third largest loss out of everything. But I want you to take this chart and not think about the past, but rather think about the future. Let's think about what's doing right now very well in the bear market. All right, we're seeing real estate and rental and leasing still strong. We expect a huge pullback in this in the next few months. But utilities, energy, state and local government spending is important to think about. Waste management service, professional, scientific, and technical services, healthcare. I wouldn't touch any of those, but let's identify utilities and energy. All right, they're very strong now. So probably 6 months from now, we're going to identify the same graph of GDP every single month. What's performing really, really strong now is your future put or short in the future. So in other words, when we do ever find this bottom, whether it's in 1 month or 1 year from now on the stock market, whatever was performing well at that time is going to be time to short, whereas you're going to flip all the shorts that you can see are viable shorts, like the banks. Those are going to flip long. And what you'll notice is that financial services and financial and banking tend to, after a stock market crash hits a bottom, they tend to lead the recovery. So you want to keep an eye on them. Absolutely. They're going to be a strong finger in the wind for you of understanding where the bottom really is at when they start showing strong recovery, which is not what's been happening now. We've seen bear market rallies and then pullbacks, and that's all we've seen so far. Those are the things I really wanted to cover for you today on this aspect. We have to get in so much more specific detail in order to really, really be identifying proper portfolios for puts and shorts, how to pull off these trades, and how to set your stop losses and understanding risk management, especially for options. Ooh, boy, my people, I'm so happy we got through that. I'm not sure if y'all know this, but also down here in Costa Rica, we're getting a little bit of a hurricane right now. So that is a little bit of my explanation for the delay in round 3 fight coming out with the puts and shorts. I expected this to be a day or two earlier. So yeah, there's a little bit of a hurricane. Kind of slowed down production in many sort of ways, but we're just going to keep them coming at you fast, my people. And thank you very much. Like, subscribe. Thank you for enjoying this video with me. I'm coming out very soon with number 4, and number 4 is doing the dirty hedgy. Oh my God, the apes don't want to hear it, but you have to know about this strategy. All right, because this is how the big boys do, and we're going to play like the big boys play. All right, my beautiful people, enjoy this little clip from The Big Short and Burry. All right, peace.
Trying to make y'all comfortable. For the record, you ain't trying to grow, then it's done for you. For the record, lab on me going all the way. For the record, ain't trying to link, no time to waste. For the record.